Most traders learn liquidity, market structure, and supply and demand as separate concepts, but still struggle to execute with clarity. The problem is not information. It is integration. In this video, I will show you a simple 4-Confluence checklist that ties everything together using market structure, discount positioning, liquidity sweeps, and demand zones inside one institutional framework. Welcome back to the ComLucro channel. We'll break this down step by step, then walk through real chart examples so you can apply the same process on any market and any time frame. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, let us begin with the foundation, market structure. Markets move through different phases. At times, price trends higher in an uptrend. At other times, it trends lower in a downtrend. And there are also periods of consolidation where price moves sideways and direction is less clear. In this video, we will focus specifically on trending conditions. Let us take an uptrend as an example. During an uptrend, the market does not move straight up. Instead, it moves in a structured way, forming what we call higher highs, usually marked on the chart as HH, and higher lows, usually marked as HL. They are called higher highs because each high is higher than the previous one, and higher lows because each low is also higher than the previous one. In contrast, during a downtrend, price forms lower highs, marked as LH, and lower lows, marked as LL. They are called lower highs because each high is lower than the previous one, and lower lows because each low is also lower than the previous one. In an uptrend structure, each time price breaks the previous high and creates a new higher high. This movement is referred to as a break of structure, commonly abbreviated as BOS. Of course, markets do not remain in an uptrend forever. At some point, the trend begins to change. This shift occurs when the previous lows are broken, leading to the formation of lower lows. Before this break, price was forming higher lows. Once those levels are broken, they turn into lower lows. This break of the previous lows during an uptrend is known as a change of character, often abbreviated as CHoCH. It is called a change of character because the market shifts from an uptrend structure to a downtrend structure, and the cycle continues. During a downtrend, price forms lower highs and lower lows. Each time a previous low is broken, that move is considered a break of structure, or BOS. Later, if price breaks the previous highs and forms higher highs during a downtrend, that move is again referred to as a change of character, or CHoCH. This is a brief overview of how break of structure, BOS, and change of character, CHoCH, work together to describe shifts in market direction. Now let us apply this directly to the chart and see how structure guides our bias. If we look at this chart objectively, it becomes very clear that the market is trending upward. Price continues to print higher highs and higher lows again and again. That alone defines the overall direction. So, in a clear uptrend, what do we expect price to do next on the daily time frame? Simple. We anticipate another higher high. When trading market structure, the objective is very straightforward. Each time, we aim to trade the next impulsive move toward a new higher high. If you observe the chart carefully, you will notice something important. The market does not move in a straight line. We see strong impulsive moves, and between them we get pullbacks. Those pullbacks are the moments when price slows down and retraces before continuing higher. That is why I highlight this pullback area, to clearly show where price is temporarily pausing. The strategy is simple. We want to enter during the pullback, not after the large move has already occurred. If we mark the daily high and the daily low, we define a daily swing range. And when we drop down to a lower time frame like the 4-hour, we can clearly identify the swing low and swing high within that range. Our main objective remains the same. We want to capture the beginning of the next impulsive move upward because that is where the strongest expansions occur. If you look back at the chart, the largest pushes always begin after the pullback completes. So the real question becomes, how do we know when this pullback zone has ended and price is ready to move higher again? That is where the next confluences come into play. And with that, our first confluence is already evident. We are trading within a bullish market structure, from this low toward this high. Now we move to the next confluence, which is the premium versus discount concept. Premium versus discount is simply measured using the Fibonacci retracement tool. For this specific model, we will only use the 0, 0.5, and 1 levels. No reverse levels, no additional ratios. We keep it clean and simple. The 0.5 level represents the equilibrium point of the range, separating premium from discount. Below that midpoint, we consider price to be in discount. Above it, we consider price to be in premium. This allows us to align our entries with logical positioning inside the range. It is important to mention that there is also the OTZ, or optimal trade zone, which includes additional Fibonacci levels and can offer more refined entry areas depending on your trading style. We cover that in detail in another video in this series, where we break down the full structure and how those levels can improve precision. For now, we focus strictly on 0, 0.5, and 1 to maintain clarity and execution speed. What we want to see is very straightforward. Whenever the market creates an impulsive move upward, I expect price to retrace. During that pullback, I want price to correct at least to the 0.5 level, the first time price pushes up and then retraces cleanly to the 0.5. The second time, the same sequence repeats, another impulse followed by a structured retracement. Now the third time, price pulls back even deeper, once again moving below the 0.5 level. This provides our second confirmation. Price is retracing into discount, which reinforces the idea of a potential long continuation. If trading were based only on market structure and premium versus discount, it would seem simple. But these two confirmations are not enough. The next two confluences show us when the pullback is truly finished and price is ready to move higher. Now we move to the third confluence, liquidity. Imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding sell orders in the market. This is essential because without available sellers, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders already present in the market to execute their buy or sell positions. It is often speculated that smart money may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. This situation can create an illusion among retail traders, making them believe they are trading on the right side of the market. However, contrary to their expectations, the market moves in the direction of their stop-loss levels, and after triggering these stops, it resumes its normal trend. To thrive and succeed as a profitable trader, identifying liquidity on the chart is essential. Shifting our focus, let's examine the details of static liquidity. Static liquidity refers to specific zones in the market where a large pool of money is resting, such as stop losses or buy and sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, such as below equal lows and above equal highs, above swing highs and below swing lows, below or above dynamic trend lines and channels, inside order blocks, below or above support and resistance levels, in Fibonacci retracement levels, and near the daily candle's body and wick. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting them can lead to substantial losses. Now, instead of keeping this discussion theoretical, let us apply it directly to the chart and see how liquidity behaves in real conditions. Here's an example. We observe a brief period of consolidation. Liquidity rests below that low. Price moves downward, takes that low, and then continues pushing higher. Now let us simplify the chart to maintain clarity. All we need to see is an impulse upward, a retracement downward, and the expectation of another impulse to the upside. This expectation is logical because first, we have a bullish market structure. Second, price has retraced into discount using the 0.5 Fibonacci level. And third, liquidity has been swept. If we zoom into the impulse, since that is where liquidity is most clearly identified, we can see two instances where liquidity was taken. If this is difficult to recognize on this time frame, simply move to a lower one, such as the 1-hour chart. There, the structure becomes obvious. Price forms ascending lows repeatedly. Once those ascending lows are taken, price reacts, pauses briefly, and then moves higher. Now we return to the 4-hour chart, fully aware of where liquidity was located and that it has already been cleared. That completes the third confluence in our checklist. Now we move to the fourth and final confluence, which is the supply and demand zone. The simplest way to understand a demand zone is through order flow. We focus on the strong sell move that occurred just before a powerful buy move, especially when that buy move caused a break in market structure. Traditionally, many traders are taught to mark a very small demand zone or just an order block, usually the last candle at the bottom of the move or a single imbalance candle. Then extend that zone forward and look for buys there. This approach is common in smart money concepts, but the reality is that the market is not perfect. Instead of trying to be overly precise, what we want to do is mark the entire sell-off that took place before the strong move upward. Once price clearly reacts from that area, we can say we have connected with a demand zone. Now, that is only one part of identifying demand. The second part, and the more important one, is waiting for a change of character, because that is where the real demand zone for entries is formed. You can see it clearly here, that a change of character happened on the lower time frame. Price pushes down, pulls back, then pushes down again with a wick. That move takes liquidity, and immediately after that, we get a strong push upward. That strong reaction is the key. What does that create? It creates a sell before the buy, which defines a high-quality demand zone. Strong demand zones almost always sweep liquidity before price moves away from them. So now, for the next upside move we are expecting, our plan is simple. We wait for price to retest that demand zone. When price returns into the zone, that is where we look for our long entry. The entry is taken at the top of the demand zone. The stop loss is placed below the demand zone, and the target is always a mechanical 1-to-2 risk to reward. Nothing complicated. And even if we had placed the stop loss below the last liquidity that was taken, we still would have had a solid risk to reward. And as you can see, price retests the zone and then continues upward, reaching our target. This is how the strategy works, using 4 clear confluences that can be applied to any market, any pair, and any time frame. All right, let's go through another example step by step. First, we need to determine the overall direction. For that, we always start with the higher time frame, in this case, the 4-hour chart. On the 4-hour time frame, price is clearly forming higher highs and higher lows, which confirms a bullish structure. We mark the swing high and swing low to define the current range. A break of structure has already formed, so our directional bias is confirmed. Next comes premium and discount. Drawing from the swing low to the swing high, we can see that price is currently trading in the discount zone. This gives us a strong reason to look for buying opportunities. That is our second confirmation. Now let's talk about liquidity. In this impulse move, there is no clear liquidity yet. It may develop during the pullback, or it may become easier to identify on a lower time frame. Now we have reached the fourth step. The demand zone has formed. You can clearly see it here, and it is positioned perfectly within the discount area. So, we shift to the 1-hour chart for refinement. On the 1-hour time frame, the structure remains bullish, and price is still within the discount area. Now we refine the 4-hour demand zone into a more precise 1-hour demand zone. After refining it, we remove the higher time frame zone to keep the chart clean. At this level, liquidity becomes clearer. We can see inducement forming, with resting liquidity that is likely to be swept before the real move begins. The expectation is simple. Price sweeps liquidity, taps the demand zone, and then pushes upward. With all confirmations aligned, we place a buy limit inside the demand zone and set the stop loss just below it. The target is placed at the previous swing high. As price moves, it taps into the demand zone, triggers the entry, and then rallies upward, creating another break of structure. This entire setup follows just 4 simple steps: direction, discount, liquidity, and demand. Master these 4 confirmations, and your analysis becomes clear, structured, and high probability. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.